What do? Do you kick yourself? What does
No,
Warren
I
Buffett
don't.
do?
Because I made so many mistakes. You know, if I tried to kick myself, my legs would be exhausted. I mean, no, you don't kick yourself in the investment. And incidentally, you don't kick yourself when you make a mistake. I mean, it is part of what you do. And I was there when Ted Williams batted 406, but that means 594.
Right. So we have actually a really good question from a student currently. For young investors trying to develop their subjective investing judgment, what is the best way to learn and grow?
Well, the best way to learn is by being wrong for a while. You know, you learn nothing from success. And my 2018 book was called Mastering the Market Cycle, and it talks about the economic cycle, the profit cycle, the psychological cycle, the real estate cycle, the market cycle, all these different cycles. And the last chapter is on the cycle and success. And what I say in there is that you learn nothing from success. What you learn is, I can do it, it's easy, I can do it again, I can do it with more money, I can do it in other fields, and I can do it without my team. And these are terrible lessons. And the day I came to work in September of 1969 at Citibank's research department, if you would have bought the Nifty 50 that day, which career-wise I did, and if you held it for 5 years, these were the greatest companies in America about which people believed, number one, nothing could ever go wrong, and number two, there was no price too high. If you held those stocks for 5 years, you lost over 90% of your money. And that was very educational. And what I took away from that was the conclusion that it's not what you buy, it's what you pay. And that success in investing doesn't come from buying good things, but from buying things well. And if you don't know the difference, you're in the wrong field. And so you got to learn those lessons at some point in time.
Let me get to this question from Tony Huang. He says that he's teaching the introduction of personal finance and the introduction of corporate finance to undergraduates at Indiana University in Bloomington. Most of his students are non-finance majors, and this will likely be the only finance class that they take in college. What should he teach them, incorporating as many writings and speeches that you've given over the years so that they have the foundations and common sense to effectively deal with their personal or corporate finance problems later in life?
Well, that's a good question because it's a big question. And if you have good judgment, your life will work a lot better than if you have bad judgment. And you get good judgment gradually over time, partly by making bad judgments and having them not work out poorly. And so my counsel has always been to start trying to be better and keep trying to improve all your life, and you got about half a chance. If you don't do that, you got like no chance. And so I used to say I can only teach what the other person almost knows. Then I can just throw him over the brink when he's hanging on the edge. But if the guy is not within miles of even starting, I never make any public. I never succeed. So in removing idiocy, I have a 100% failing talent. I've never succeeded.
What would you push in that direction if you've got a class full of finance students in college? Maybe what are a few lessons you can?
I would teach to the people who can learn, and if the others couldn't keep up, the hell with them. It can't be improved. I don't believe in butting my head against the wall.
Partner Rob Goldstein, who joined me in 1989, always joked that if we worked for someone else over the last 15 years, they would have fired us about 8 times. So you have to be willing to, I guess, make mistakes, and you can't really avoid it. Things happen. It's a lesson in concentration. It's a lesson in operating leverage. I learned a lot of things, and I can still safely say I'm always learning. I'm always making a new mistake. I'm trying not to make the same ones, but the same ones usually have a little different face on them. You're really making the same one, but it presented in a little different way, and you didn't notice it, and you would go make that mistake again. And so I guess advice would be don't be shy about making mistakes, because you will anyway. So,
well, I think that's very important what Joel just said, and I want everybody in the audience to take cognizance of it. I wrote a memo in April called Dare to be Great. And basically it said, if you want to be exceptional as an investor, you have to dare to be great. Everybody here is willing to be great. But to be great, you have to be different. Because if you think the same as everybody else, you'll make the same actions. If you take the same actions, you'll have the same performance. You certainly can't be exceptional if you follow the common course. So to be exceptional, you have to be different. You also have to dare to be wrong. And nobody bats 1,000. The best baseball hitter in history got 4 hits every 10 times to the plate, right? Some investors can do a little better than that, but nobody bats 1,000. And Joel mentioned that he could have been fired 8 times, and I'm
a very kind boss, so I let myself stay.
And I had lunch today with a guy who works for Berkshire Hathaway, and we were talking about what makes Warren successful, and I said one of the things that makes him successful is not afraid of getting fired. But very few people have that luxury. And the question is, for those of us who work in the world where we can be fired, if not by our employers, then by our clients, will we still take the chance and back our ideas that there are no sure things? Will you back the things that have a chance of being wrong? And I think you have to take that chance.
What Monish is saying about starting as early as possible. It's not just a runway, but as you know, we are human beings, and the earlier you start, what you will have is that you're going to make mistakes. And when you make mistakes when you're young, it's much easier to bounce back and say, okay, what I'm thinking, I was thinking this way, and I thought I would make a lot of money, but it proved I was wrong. Therefore, you can start early. So if you start at 25 versus 50, at 50, if you make that same mistake, you would consider yourself an utter idiot. But at 20, 25, no, you just start again. So you have that benefit when you're younger. So you can make mistakes and you can bounce back. So I was fortunate. I started investing at a really young age, and I've made a lot of mistakes, and I was able to bounce back without really hurting myself. So you have to give allowance something for mistakes. Even we as portfolio managers, we are only right most probably only 60% of the time. 40% of the time we are just either making mistakes or they're not right decisions. So those are the batting ratio to give you a rough idea.
Experience is making mistakes and learning from them. So that's what I learned. In fact, I don't know that I've, every day, over the course of your existence, you make various mistakes, whether it's socially or whether it's in business. But the ones you really remember are kind of the bigger ones. So the JCPenney one certainly got a lot of, the problem with our strategy is we're very concentrated. We manage 11 or 12 billion of capital. So when we make a mistake, it's going to be really big, right? The numbers are, we lost $500 million on JCPenney. Well, that was 4% of our capital. Now that sounds a little smaller, but that's not how the press is going to present it. But it's very, very helpful to have mistakes that you notice. And so I wouldn't run around engineering mistakes. What I would do instead is to value them, right? I think the natural tendency when you make a mistake is to try to forget it as quickly as possible. When what you should do is the opposite. You should study it. And business schools, the case method is largely about that. A lot of cases are, what should you do in light of a failure or a mistake? And that's why it's the best kind of mistakes are ones that you can practice with, theoretically. But the ones you really, really learn are the ones where you feel, something in your stomach or in your wallet or some combination of the two.
In the investing business, you need a high degree of confidence, but you also need a high degree of humbleness, and you have to balance those two.
And where's the humbleness?
Humbleness comes from mistakes. JCPenney has been a big disappointment, and you learn from mistakes like that. General Growth has been an incredible success. You learn from, so you need to do sufficient amount of research and homework And when you place your bet that you have confidence, I mean, investing is a business where you can look very silly for a meaningful period of time before you're proven right. I looked very silly at MBIA and attracted a lot of scrutiny in the press.
And did you ever doubt yourself?
No.
You know, we all end up having losses and things. It's just a fact of life. I don't know of anybody who's been able to do it perfectly forever. And so, you know, learning how to learn the lesson from the losses, it should not be because your thought process was wrong. It should be because things went on outside of your control entirely.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, I mean, you know, it's funny in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company and then it doubles, then it triples and quadruples because you make a lot of mistakes. And so it's ones that go up tenfold. I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high. And I was wrong. And you had to figure out what inning am I in this baseball game. I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. And that's what I do with the company. And that's your decision. That's how you sell it.
What are the most conspicuous mistakes you've seen investors make?
Well, I think not looking at the balance sheet, and this is a mistake I've made. If you look at, if you look at a person's balance sheet, you look to see what the assets they own, their houses, if they own a house, if they own a car, what debt they have, and take that away. That's what your net worth is. You should do that with a company. And I've seen investors look at companies that made, let's say, looking at 2 companies, they're very depressed. They're each at $4 a share. But one company's, and they're each losing a couple $1 million a quarter. One company has $100 million in cash and no debt, and one company has no cash and $100 million in debt. They're about to blow taps on the second company. So and you could do this. If you get through 8th grade math and you get anywhere near 8 and 8 equals 16, you can do this. Look at a company's financial position. It's impossible to go bankrupt if you don't have any debt. I mean, you get the Irving G. Thalberg Lifetime Achievement Award. I think they're bad management. I mean, how could you do that?
And I add the part about leverage because, again, from mistakes, in the 2008-2009 financial crisis, I had some tough losses. And again, I think you learn more from things that don't go well than when things do go well. And I looked at some businesses that I did not really appreciate how much leverage was inherent in what they were doing. There's 2 types of mistake you could make when you're doing your valuation work. One is that you pay too much for something. So you make this judgment about what something is worth, or you make an error in those calculations and you pay more than something is worth. And that's a frustrating error, but you've laid out some money and it doesn't really earn much of a return or less of a return, or maybe even loses money compared to what you paid out for it. That's not the worst thing that's ever going to happen to you. That's an error that you can recover from. The kind of errors that are harder and that really cost you more, although it's a hidden cost and it's an implicit cost, is that you thought about what something was worth and you thought about what you wanted to pay for it, and this was something that actually did compound and you never bought it because it never met your test of valuation, but it just kept on compounding over time. That example, it's easy not to talk about it. And I think if there's one thing that I've been thinking about a lot recently is, as human beings, we tend to have very vivid memories of things that we did and things that happened to us, and especially that happened to us recently. We tend to not have vivid memories and not do well about thinking about the things that didn't happen to us or that we didn't do. And we can brush away those experiences relatively easily because we don't have firsthand experience with it. So we probably all have stories about something, and the older you get, the more stories you will have like this, where you thought about something, or you thought something might have been a good idea, or you thought that might have been a good business, or you thought that might have been a good stock at a certain point in time. But for whatever reason, pricing or whatever, you didn't buy it at that time, and then you never got around to buying it. Those are the things that really hurt. That money that you didn't make will end up being a far bigger subtraction from your theoretical end net worth than the things that you did buy that perhaps did not work as well as you hoped they would.
Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.